Thank you for joining us today for Big Tax Strategies for Small Businesses, part of the Small Business Webinar Series. My name is Duke Nguyen Abrahamson. I am the Executive Director of the Asian Pacific American Chamber of Commerce, also known as APACC. This year, APACC celebrates our 22 years of facilitating business relationships among Asian-owned and U.S.-based companies and promoting the economic advancement of the Asian American Pacific Islander. Businesses owned by Asian Americans with heritages from China, Japan, Korea, Taiwan, Vietnam, the Philippines, and India, among other countries, Fortune 500 corporations, entrepreneurs, business professionals, cultural organizations and associations, and political and government dignitaries have supported APACC throughout the years and are the reason for our success. We are a collective voice for 30 plus Asian and Asian Pacific countries. We are able to do this through our strategic partnerships with Asian cultural associations throughout Michigan and nationally, and through our sponsors. Thank you to General Motors for supporting AAPI small businesses and National ACE for being our national partner. Let me introduce Laura Van Hoody, APACC's Small Business Action Committee Chair. Laura is a benefits consultant with Hub International, an employee benefit firm with 7 Michigan locations that serve both small and mid-sized businesses. Laura?
Sounds good. Thanks, Duke. Welcome, everyone. Super excited to be here on this fall day. And I have the pleasure of introducing Shayla and HP from Raymond, who I will transition over in a little bit. I just wanted to give you some background on the Small Business Action Committee. We actually formed fall of last year, so it's almost 1 year. And our mission is really to not only educate small businesses by bringing webinars and writing different articles, but really to seek in information from you as small business owners on what are hot topics that you're looking to learn more about? What are some frustrations you're having? What are some successes? And with that, we've been really supported by GM through a grant that has allowed small businesses to be part of the chamber and receive such educational information for no cost. So today we get to hear from experts at Raymond, which is a business consulting, accounting, and tax firm. They do many different, they provide many different services, to small businesses. And I'd like to turn it over to HP and Shayla from Raymond, who will then give a bio about themselves and really dig into the information. So HP and Shayla, thank you.
Thanks, Laura. Fall is my favorite season, so this is a good time to have a webinar. Like Laura said, my name is Shayla Kulaglich. I'm a senior manager at Raymond in our advisory and tax department. I've been with the firm for just over 10 years. I work with individuals and business owners on corporate flow through and estate matters as well, advising on entity structuring and foreign investment in U.S. real estate. So we have a pretty robust international tax group that I'm a member of. And HP.
Hi guys, I'm Himanshu Puri. I'm with Raymond for about 7 years now, and I'm a senior manager as well and a part of advisory and tax group of the Raymond. I work a lot with individuals, corporations, flow-through entities in the area of international taxes. Actually, Shayla and I are in the same group for the most part. And then after recently, when CARES Act was passed in 2020, I became a part of a special credit group evaluating a lot of credits for the companies. And one of the credit we'll be talking during our webinar.
Yay. So I'll be sharing my screen. I do apologize because my camera keeps going in and out, so it gets a little blurry, but you should see the presentation pretty clearly. So like Laura said, we'll be talking about some tax strategies for small businesses and the respective owners. We'll start off by talking about structuring a business, how that works, what are the tax implications, and mainly just focus on the different types of structures that your business could develop or be in. We'll also dive into some business tax minimization strategies. A big one, ERC, the employee retention credit that Himanshu will talk about, and how that kind of impacts business taxes. We'll talk about R&D and some recent changes in that world. We'll dive into business owner tax considerations, specifically as it relates to self-rentals and some grouping elections that a lot of business owners aren't aware of. Some S-Corp owner salary and partner payment examples and how to structure those and the benefits of each. And then we'll talk about QBI deduction, the qualified business income deduction that was passed through the CARES Act or TCJA, and that Himanshu will do a really nice summary of. And then end it with some tax reform reminders and CARES Act opportunities. All right. Okay. As far as business structure and classification goes, there's really 4 different types that your business could be doing business as, and options as you're starting off. So we have a C corporation, an S corporation, LLCs, limited liability companies, and kind of with that classification are LLPs, limited liability partnerships, and then sole proprietorships, which are also very common. So I kind of divided this up by liability of owners, numbers of shares, and then the differences in the profit, loss, and distributions. I love charts, so I prefer them over written content. But on the liability side, as a C Corp, liability of an owner is limited, even if the shareholders participate in management. So that's a good reason to be set up as a corporation. Within an S Corp, same thing. It's limited as even if the shareholders participate in management. Then when we dive into LLCs and sole proprietorships, LLCs are often limited as well, but a sole proprietorship usually often is unlimited. So there's a lot of exposure on the legal side where an individual or someone starting a business would want to set up an LLC or some sort of layer to protect their personal assets. Most of the structures, the 4 different entity classifications or structures have no maximum owners except for S corporations. So that's at 100, but usually with small businesses, you're not even close to there. So, but as far as profit and loss and distribution goes, the really attractive thing with LLCs and C Corps is that you're allowed to have special allocations of profits and losses. Whereas with S Corps, you can't. If you're a 50% owner, you get 50% of the profits. With an LLC, I could have an operating agreement that states, okay, I'm contributing, I'm the only partner out of us 2 that's contributing cash, and the other partner is not contributing anything, maybe services. So I get share of losses before they can, get any shares of losses until their capital or they've contributed something into the LLC or partnership. So it's very attractive because it does afford that flexibility to organize how profits and distributions are allocated. And I do have a little asterisk with a note that, LLCs, once they're set up, if they're set up as by one owner, if you don't make any elections, it's taxed as a single member LLC, which means that all of the income and losses pass through to that one partners or members 1040. If you make LLCs are pretty flexible with elections as long as you have the right, owners or number of owners. You can elect it to be taxed as a partnership if you have 2 or more partners. So they're a favorite of many startups for several reasons. Okay. On the tax side of things, C corporations are the only non-flow-through structure. So with S corporations, LLCs or partnerships, and sole proprietors, the income and expenses flow through to the actual partners or shareholders where they pick it up on a 1040. And the means for picking up the income or expense differs. It could be through a K1 with an S corp or an LLC, or directly on a Schedule C of a 1040 if you're a sole proprietor. So C Corps don't distribute profit, or they do in a form of a dividend, but the income and deductions of the C Corp is retained within that entity. But with the other structures, it is passed through, which is why we call it a flow-through structure, passed through to the owners that they pay tax on. NIT, net investment income tax, which is a 3.9% tax assessed on investment type income, is charged on, or is assessed on most of the income from these entities except for S corporations. And then self-employment tax, that's a big one because it's so high, but it's assessed at every level, or for the LLCs and sole proprietors and S corps, but not for C corps. But there is more planning opportunities with self-employment tax at the S corp level, which makes them more attractive, and I'll go over that in a little bit. Can we avoid double taxation in any of these structures? Yes, for LLCs and partnerships and sole proprietors, usually with S corps and then C corps, no. And then just the tax forms that they would be filed on. So S corps and partnerships have some benefits where tax planning can be implemented, and we'll go over those in a little bit. All right, turning it over to HP.
Hello, everyone. The two best things happened during, as far as taxation is concerned, during when the CARES Act was passed and when pandemic hit was, from tax point of view, was you might know about PPP loans, which was essentially a free stimulus money given by the government to qualified businesses. And the other second big thing happened was employee retention credit. And employee retention credit applied in 2020 and 2021, both years. So essentially, since inception, it has been created by two additional stimulus measures that were passed. So the credit now has different rules for 2020 and 2021. And we'll go over those rules. It applies to both the years, but the slight qualifications rules are a little bit different. The ERC, the employee retention credit, is refundable tax credit. It rewards businesses who kept employees during the COVID pandemic up to $26,000 per employee. Essentially, how I'm coming with $26,000 is hypothetically, if a taxpayer qualifies in both years and they maximize on the credit, the maximum credit you can get during 2020 year is $5,000, and the maximum credit you can get in 2021 is $21,000. So that's how 26 is the best case scenario. But of course, like each calculation, each taxpayer is different, and we have to go through the numbers to actually find out how much credit per employee you will get. Next slide, please. So this is a good summary in essence to 2020 eligibility rules. In 2020, there was like a lot of restrictions what company could qualify. One was it applied to all non-government entities. So back in 2020, they said, well, if you are deemed as a government entity or heavily affiliated with the government entity, you can't get that credit. There are two ways you could qualify this credit. One is either the operations were fully or partially shut down due to government mandated order. Or the second version is if you have more than 50% drop in gross receipts when comparing 2019 versus 2020 quarters. So that's generally, when I'm talking to clients, mostly like I start off with, let's request P&L by quarter for 19 and 20, and let's compare if we qualify under that test, because that's more of a black and white test and there is no like areas to manipulate. Whereas when you get to operations or fully suspended test, it could be deemed, how you're reading the tax law, and everyone read the tax law in a different way. So that's our starting point. Once you qualify, we tested your revenue decline basis or shutdown basis. Once the entity qualifies, then second question I'd normally ask is, what's the average number of employees you had in 2019? Full-time employees only. And we can ignore part-time employees altogether. So if in 19, if your average full-time employee count during the year was less than 100, then all the wages that you paid qualifies for the credit up to a certain limit. But if your full-time average employee count goes over 100, then that's dent the credit qualification of the wages heavily. Because at that point, if you paid someone for not performing services, so if I give an example, I did several manufacturing clients who qualified, who passed the first test, but on the second test, they had average full-time employees of more than 100, but they were affected by the shutdown or they had a revenue decline. So in that case, they didn't want to let go their employees. So they kept their employees during the payroll and they kept paying those employees for not performing any services. So once you cross that 100 employee mark full-time, that limitation kicks in. So in 2020, that was for a lot of clients, who were affected by this rule. This employee retention credit got a big hit because once you cross that, then it's only limited wages that qualifies for the credit. Then the next one is what kind of eligible costs are there that qualifies for that? Once you pass that first test, which is eligibility, and the second, now it comes to what kind of gross wages or what kind of wages qualify for this credit. So in that case, your gross wages subject to FICA taxes. So what that means is, normally I ask for, your Medicare wage report by employee by check date. So that's the easier one. And then if you paid anyone, if the company paid health insurance benefit, that includes vision, dental, health. So if you paid that on behalf of your employees, that also qualifies. So I had several clients who were over 100 employees, who didn't meet that 100 mark test, but they, instead of laying off their employees, they kept their employees, but they kept paying their health insurances. So because the number was so big, their credit turned out to be very big still. The third time is how much, one question is always asked, like how much credit I can get, because all this, is a lot of work on both client side, because they have to, find out all that documentation that we request, and then we have to analyze it. So it's a lot of work involved in both sides. So generally the question is, what's my benefit if I go through this exercise? So in 2020, the maximum credit you can get is $5,000 per employee during the year, which is 50% up to $10,000 in wages. So once you say qualify for a certain period, you paid the employee $10,000 in wages, and you got 50% of the credit, which is $5,000. Then even if you paid more, it's not required because you met that 5,000 limit per employee. The one key thing is initially when the rules were passed, and that's when I saw no one went after this employee retention credit, because the primary rules were like if someone took PPP loan, they can't have this ERC as well. But then later on, the rules changed. They said, well, you can still take ERC. However, you can't use double benefit. Means you can't use the same wages for forgiveness in PPP and same wages to claim the credit. Of course, there's, whenever we talk about taxes, there's always statute of limitations, like how far can we go or how much time we had to take the credit. So that statute is 3 years. So in a simpler terms, if you qualify the credit in 2020 Q1 for a certain thing, or 2020 in Q2, when you file the 941, that date, originally filed 941, you have 3 years now. So for a lot of taxpayers, this upcoming summer, if you haven't claimed the credit for 2020, that's going to lapse. After that, you have no option to even claim the credit. So next 6 months, 8 months, if you haven't used this credit ever yet, that would be crucial to figure out next 6 months are key. Otherwise, you're going to lose the credit if you qualify. How do you claim this credit? By filing 941s. So we've once the steps are understand the eligibility rules, do the calculation, and then claim the credit on 941. Once the 941s are filed with the government, I am seeing right now, generally the timeline the government is taking to process these amended 941s is somewhere between it's changing every year depending upon how many people. I think IRS is backlogged severely in their end. So it's moving somewhere between initially I was saying 6 to 8 months or 9 months even from when you file this claim. But now I'm seeing a lot of my clients receive the refunds within 6 months. So that's a good news. But the good thing is government is supposed to process these claims within 3 months. So if the more time they take, you never see that, but government will be paying you more money in the face of interest. Next slide, please.
And one thing I just wanted to mention is there's some confusion on this, but this is a payroll tax credit. It's not a credit you claim with your income tax return. So that's why you have to amend your 941s and by quarter. So when you get refunds, you will get them on a quarterly basis. So you won't get one big check for everything. It'll come in depending on which quarters you qualify for and amend, you would get, the checks for that quarter. So.
Thank you, Shayla. The second now is 2021 rules. As I said, like the rules changes slightly a bit. So first time it was only non-governmental entities, but now Congress said, well, that's not fair. So let's add more taxpayer to that list. So now colleges, universities, hospitals, medical care providers, even if you're, somewhat affiliated with government, you still qualify. The tests are pretty similar. Like the shutdown test is same. You still look at, are there any government mandated shutdown that apply to your business? And this is the area, I've seen, consulting with like hundreds of clients in this area, that a lot of times a taxpayer thinks they were not shut down, but when we dig into rules and when we dig into numbers, it suggests, you don't really qualify under revenue. You don't have enough revenue decline to meet the criteria, but that big enough decline kind of suggests that we need to unlock how much is we need to understand more story behind the scene, because just thinking, government didn't really shut me down, so we're not going to qualify. That's not true. And I'll give you an example. In restaurants, even though I know a few of my clients, their business doubled actually in 2020 because their carry out was doubled. But you can't take the fact away that in Michigan, restaurants the indoor dining was shut down. So even though your business doubled, that fact you still were restricted to business, you still qualify. You can still make a case. And then same thing, like I can tell you, automotive suppliers, generally government said, Michigan orders kind of said, well, if you're deemed essential, you don't really have to shut down. But then you have to look into, were you serving any clients who were deemed non-essential? So you were doing some manufacturing if you're doing for essential manufacturers, that it's a hard case to build. But if you're doing some work for non-essential manufacturers and those projects were suspended, there is a possibility to evaluate, did you have a shutdown? And if that shutdown was to your customer was related to one of the COVID orders. So the key theme is whatever shutdown you're taking, we have to support that with some kind of government order. It doesn't have to be state government order. It could be federal health department government order, city government order. But, just having, we were restricted due to supply chain issues. That's not enough. It has to be backed by the government order. So that's the key there. And then, of course, the revenue decline rules, Congress said 50% revenue decline in gross receipts. Comparing 19 and 20 last year, 50% is a big number because a lot of companies, if they had 30% decline, they have a major impact. So they changed that rules to now, okay, when you're comparing 2021 quarters to 2019 quarters, the drop has to be more than 20% only. And I've seen, based on all the calculation I have done, that a lot more businesses qualified with this 20% decline under revenue decline test. And once you qualify under that test, we don't even have to evaluate government shutdown test anymore. So it's one or the other, or you can use both. Then the second big change in eligibility rules in 2021 happened in the full-time FTE count, full-time employee count average. So in 2020 slide, you will see it was 100 number, but now it's 500. So I saw a similar taxpayer who didn't qualify or who didn't pay, who got stuck with limitation with 100 employee count. They got big amounts of credit under this new employee count rules. So that's one thing need to be looked at. The cost is pretty same. It's gross wages, which is subject to Medicare taxes. plus employer portion of your healthcare plan that employer pays and your employer pays for you. Again, this credit is an employer credit. I've seen a lot of questions that is this employee credit? Nope, it's a benefit to the employer. And the goal of this credit is, the soul of this credit, I would say, was if employer kept people on payroll and they were impacted by businesses and they kept people employed, this is the help for that reason. Maximum credit, in 2020, the maximum credit was only $5,000 annually. But in 2021, the credit is by quarter, and it's $7,000 per employee. So it's a big number coming from, and in 2021, the credit is only available for first 3 quarters if you qualify. So it's a big change, so that means your credit is like 3 times more, probably 4 times more. So now the maximum credit, how that $7,000 comes up, it's 70% of your wages up to $10,000. And no double dip, same rules. Like you can't use same wages for PPP and and employee retention credit. There are more rules in addition to PPP. Like in 2021, a lot of companies claim R&D credits. So there is additional analysis needs to be done that you don't double dip to. So if a taxpayer uses R&D, PPP, all that, the calculation, once you qualify, calculation is complex, but this is one of those claims that, if you have employees, which is outside the owner and you paid wages to them in 2020 and 2019, if you haven't used or if you haven't assessed this plan, or if someone told you don't qualify, rethink, because, that's the key. It's a lot of money left on the table if you don't do it. Application deadline, same statute, 3 years. But in 2021, the statute is not big concern because 2021 just happened last year. So we have 3 years. So claiming we're rushing upon time with 2020 now because in the next 6 months, Q2 will expire. But in 2021, that's not the thing. But the faster you do this or assess this, the faster you'll get the money, because remember, there's a processing timing on the government side as well.
And HP, I think you said before that the refunds are being issued. Like the IRS isn't really auditing these right now and saying, oh, no, you don't qualify, because the IRS doesn't have any support. Yep. So it's a matter of they're going to issue, once they review the 941s, more than likely they're going to issue it. And then the audits could be likely down the road. So having that substantiation and documentation that you qualified is vital, because they will be looking at these.
Yeah. And generally we do, as a part of our process, we do a comprehensive report covering those facts. So if you're getting audited, all we need to do is we covered our corner and give that report to the IRS auditor, and he would know with that 2 or 3 or 4, depending on how big the operations are, he would know exactly all he needs to know about the eligibility of the credit.
Yeah.
So
and we're running a little bit short on time, so some of this we might have to shorten.
Yep, and a lot of the slides, you will see, I want to provide a little bit more information. So, people, if someone looking at these slides, it may not be immediately useful, but they know a little bit more so some of the slides are more of an informational purpose. Like this slide, the story of this slide is, it's mostly you can't use the same wages that you use for PPP forgiveness. Likewise, there is a adjustment to wages if you use work opportunity tax credit on your tax return, or if you're using R&D wages, there is adjustment needs to be done. Then last main thing is the ERC refunds are taxable. Essentially, when you get the credit, you reduce your wages, and in its essence, it becomes taxable. So what that means is, in addition to amending payroll returns, if you claim in future, you have to retroactively go back and amend maybe possibly 2020 or 2021 returns as well.
And this might be a big hit, because if you're getting a big credit, we have one client that is getting a credit of $9 million.
Wow.
And that's one of our bigger clients. But they have to reduce their 2021 wage deduction on their tax return by $9 million. So that means they have to pay tax now for a refund that they might not get for 3 or 6 months. So there's some planning we need to do on, do we pay in installments until we get the rest of the money from the ERCs? Because it could be a pretty substantial tax that you have to pay now, because you're losing the wage deduction. But more more than makes up for it when you get the refund.
Yeah. So because it's a dollar for dollar refund, so it means if you got a $9 million tax credit and you're at a 35% bracket, so you're paying only 35%. So your net cash in your pocket is your tax plus the fee that you pay for this project. And generally, if you're thinking about what's my net cash benefit in my pocket, I've seen somewhere between, after paying taxes and the fees, it's close to like 50% money gets in your pocket. Next slide.
It's worth it.
Oh yeah, absolutely. And we do when we take on these projects, we do several things to maximize the credit. So we do PPP expenses and ERC wage by wage analysis. So the key is to just leave enough wages for PPP so we can use the extra wages for our ERC purposes. So we do that detailed analysis. And a lot of times we have seen, like, if you lose the whole PPP wages out of the picture, you get a smaller credit. But if you do this extensive employee by employee, check date by check date analysis, your credit generally, I've seen changes in credit up to like, $50,000, $60,000. And we're talking about a few hours of more time, maybe $1,000 or $2,000 additional in fees, but the benefit is far more. And we do that, we actively involve, like we almost like lead this practice a lot. We have a full team dedicated to this. If you have any questions, please feel free to connect with us. One thing out of caution, when you look at that gross receipt test, which I talked about more than 50% or more than 20% for 2021, aggregation rule applies. It means if, example, I own 5 businesses. So if I'm testing that rule out, I have to combine those gross receipts for all 5 businesses and test if I have a 50% decline or 20% decline. I think a lot of time that this key thing is missed. Limitation placed on wages paid on more than 50% related employees. What that means is if I own 100% of 5 businesses, I'm paying myself wages or my wife wages, my kids wages, all those wages, because I own more than 50% and anyone related to me, their wages wouldn't qualify. It's more of wages you pay to your non-related, employees. So that's one limitation there. Next slide, please. You might have heard a lot about this. I just wanted to mention it out because it's, if you haven't know about this, it's going to bite back at some point. So the big change is before, the entities who take R&D credit for research and experimental expenses, you could get a deduction, you could get a credit, and you could also get a deduction at the same time. So it was like a double benefit, you could call it. So you're making a cake and you're eating it too. But now, starting after 2021, as of the rule stands now, this may change. It's still in Congress, and I hope is it get repealed before we file the 2022 return. But as of the rule now is those expenses that you use to claim the credit, those needs to be capitalized and amortized over, if you're a domestic company, 5 years, if you're a foreign, it's 15 years. So what that means is, you'll get to take the full credit, but all the deductions all the expenses that you use to come up with the credit, you have to capitalize those. So it's a big hit on your expense, expense taking ability. That's one key thing. It's happening, and this needs to be addressed during your tax planning phase because you don't want to find out later if this rule didn't get repealed. Now you don't have $1 million of expenses because you used in R&D credit. And this is not an option. Even if you choose not to take R&D credit, you still have to go through this exercise.
You still have to capitalize.
You still have to capitalize.
Okay.
So that's a one big change. But the hope is there's talks in Congress. They may repeal it before. But the hope is before we file the tax return. Otherwise, it will be in the position of amendment.
Yeah, so it's a good reason to extend. Maybe pay the tax, a little bit more tax up front, but to have time to be able to figure that all out.
And that's a good point. I think, if this rule we're anticipating this rule will be passed, the extending return beyond the due date might be the right thing. Otherwise, you have to amend.
Mm-hmm. Cool.
Next slide, please.
All right, back to me. Fun stuff. And I'm actually I don't have content slides, if you will, so we can pretend that these mics are partners and shareholders we're talking about. But many taxpayers own an operating entity, also have an accompanying real estate. So if I buy commercial real estate for my company, for operations, I usually will put that in a separate LLC. As if I were doing the thinking, my thinking would be, I want the real estate to be in a separate LLC so that it's protected and separate from my operations. So a lot of times we'll see the building and land owned by a separate entity, and the operations are in another LLC usually. So if the operating entity the shareholder actively participates in on a day-to-day basis. So if I'm the shareholder of this operating entity, in most cases, I can deduct, or I would be taxed if I'm materially participating on a day-to-day basis. I will be taxed on the income, and then I can offset, I can use my losses immediately in the year that they are incurred. So they're considered active losses because I'm materially participating. The general rule is when you have rental real estate, and what we refer to, which I'll go into, is a self-rental, where your operating entity is renting the real estate from your other LLC that you're holding it in. If there's losses, you usually can't deduct them in the year that they're incurred. They're usually passive losses that get suspended and carried over to next year. So there's some complications or unintended, consequences when you do separate the real estate from the operating entity, because you're taxed on the income from the operating entity right away, but then you can't take those losses from your real estate entity, even though they're related. So the suspension of those passive losses isn't very attractive. There is an option under Section 469 to group those entities. And basically what we would be doing is making an election, and the election does have to be made in the first year of the entities when you're filing the return. What you're saying is these entities are so far connected that it makes sense to group them. And when I have a loss from the self-rental real estate entity, it's going to offset my income from the operating entity so that you can reduce your taxable income. So combining the rental activity with the operating activity, you could also consider doing an actual merger if it's, you keep getting every year you keep accumulating losses from the real estate entity. But the election is a far easier, I believe, way to claim those losses. And again, it's called a Section 469 grouping election, and it groups your legal entities if their activities constitute an appropriate economic unit. And that's the key here. And it's a facts and circumstances test, of course. There's no bright line test that says, yes, my activities are an appropriate economic unit. But the biggest factors, or the factors that are given the most weight in this grouping, are similarities and differences in the types of trade or businesses, the extent of common control, which usually you meet that because the shareholders or partners, there's usually a couple that own both entities, the extent of common ownership, geographical location, or the interdependencies between the activities. So my self-rental or my operating entity is pretty dependent on my real estate entity for the space. So there's usually with when you have a self-rental, you usually can group those as long as you meet the ownership and control tests. And I just want to say this again: it has to be an election that's made in the initial year that the taxpayer reports the activities. So you can't do it 5 years down the line when your real estate entity starts having losses. You can't pick and choose when you want to make this election. It has to be on the first year.
And I can say one more thing about that one. The best time is, for example, I'm running a business. I'm running a small manufacturing unit, and I'm renting a space right now, right? But now my situation is better, and now I'm choosing to buy a new building, right? And now, since I'm going to be owning that building, that's a perfect time. That's the only time you can make this election in the first year, and you combine.
And the biggest year of benefit is actually, like HP said, because usually in the year that you purchase a building, hopefully at least, you're considering a cost seg study, a cost segregation study, which helps helps accelerate your depreciation deduction in the current year. When you have that, it's that year that has a big loss because of that one-time depreciation offset or the larger offset in that year. Okay. On the owner side of things, this gets a little bit fun, but again, no more slides than this. An S corporation flow-through income has an employment tax advantage over that of what we saw sole proprietors, partnerships, and LLCs have. So a shareholder, an S corp shareholder's undistributed share of its income is not treated as self-employment income. Whereas earnings attributed to a sole proprietor, a general partner, LLC, or really an LLC member are subject to self-employment tax. So there's this clear benefit to having an S corp. And since the S corp income is not subject to self-employment tax, there's tremendous motivation for a shareholder or employee. So if I'm a shareholder and I'm also being paid out of the S corp, I would want to have an S corp to minimize my salary, increase my distributions, since the distributions aren't subject to employment tax. And of course, the IRS caught on to this, and to prevent the S corps and their shareholders from avoiding payroll taxes by maximizing distributions and reducing salary, they are requiring S corps to only pay shareholders who provide substantial services and that's considered reasonable compensation. So if I own 100% of an S corp and I basically do everything I'm a CPA. I set up my own C corp or S corp, and I'm the sole employee, and I pay myself, let's say the profits are $1 million, and I pay myself a $20,000 wage, but I'm the one doing all the work. There is no justification for that. So I need to assess with my advisors, what is reasonable compensation? What would a CPA in this type of firm, in this type of industry pay themselves so that it's considered reasonable compensation? And any excess would be a distribution that's not subject to self-employment tax. So shareholders have to show that their services that they're providing to a corporation aren't substantial and that their comp is reasonable. And the IRS still to this day continues to look at this. It's still a hot topic because there's a lot of abuse in this area. So you want to be careful, but it definitely presents an opportunity for not all of your income to be subject to self-employment tax if you were a general partner in a partnership. So on the other hand, kind of to that point, partners in a partnership are taxed. They can't take out a salary. Partners cannot have a salary, and their means of compensation is really through guaranteed payments, which are subject to ordinary income tax. And they're also subject to self-employment tax, usually, if they're not for return of capital. And that's reported to the partners on a K-1. So again, general partners usually are subject to self-employment tax, and limited partners, not always. However, the key here is the thing that changed it, which HP is going to dive into a little bit after my session, but the Tax Cuts and Jobs Act, or the TCJA, added the Section 199 Cap 8 QBI deduction. And that's for individuals and trusts that are partners or shareholders of a flow-through entity. So again, S corp or partnership. And this was a big benefit because it's a 20% deduction if you qualify, but it only qualifies, the income that qualifies for this deduction is the distributive share of partnership income, and that doesn't include guaranteed payments. So if I, as a partner, used to get, if I get a K-1 that has $1 million on it, and half of that is to me in guaranteed payments, 500,000 of that wouldn't qualify for this deduction. So it presents a really big opportunity to restructure how your partners or me, I'm getting paid out of my partnership. Do I want it to be more out of the profits and losses so that I can reduce my guaranteed payments so that most of my income is going to be eligible for this deduction? So that's a big item that we've been looking at with clients to make sure that they qualify on the shareholder and partner level. Okay. Back to HP.
Welcome, guys. So now the first thing out of these, the later part of presentation, I'll be talking about, as Shayla mentioned, QBI deduction. What that is this deduction came into play when the Tax Cuts and Jobs Act were passed. And the reason was the big reason of this deduction's existence is because corporate tax rates are at 21%, whereas, possibly your individual, because this deduction goes to your individual return. And your individual rate might be 37%, the highest tax bracket, right? So to get taxpayer in the level playing field, this deduction came into play. But there are several components that restricts taking deductions. And this deductions is only for non-corporate taxpayers. So C corporations can't take this deduction. And the four main things are, what kind of trade or business do you do? Which is essentially, there's a term called SSTB versus non-SSTB. SSTB means it's a full form is specific trade or business, or is it non? And we'll explain a little bit what those words are, kind of. And then there are upper and lower income threshold limits that limits your deduction. Then once your deductions are limited, that's when the 3 and 4 comes into play, because for certain type of companies, you can use the fact W-2 wages. So even though your deductions are not there, but you can use W-2 wages as long as you're paying wages to bump up your deduction, and then some basis in your property that's in the business. Next slide, please. So the first thing is what's not qualified trade or business. So what's not is every business is a qualified trade or business, and section 162 is the section that talks about what is trade or business. First is a C corporation is not a qualified trade or business. As I mentioned, C corporation cannot get a deduction. The second thing I mentioned was SSTBs, which is essentially an SSTB is a trade or business involving performance of services in the field of health, accounting, actuarial science. So it's pretty much they're targeting the companies that are doing business as employees. So like us, most of their revenue is generated from services pretty much. So it's called SSTB. Once you're SSTB and you go over the threshold, there is no deduction for you. So that's why that SSTB definition is one of the 3 exceptions to trade or business. And then third is performing services as an employee. So a lot of questions when this came out was, hey, I'm an employee in an X company, can I take this deduction? So that's the answer, nope, because you're an employee, you're not a business. Next slide, please. So this is the good kind of chart, which kind of shows upper taxable limit and the lower taxable limit. And then if you're SSTB versus a non-SSTB. So first one is if you have taxable income before QBI, if you're a single filer, if your taxable income is, and this is for 2022, because I thought it's more suitable for next year, so might as well. So taxable income, if you're a single filer, if you're not more than $170,050, and if you're a married filer, joint, if your taxable income is not more than $340. This taxable income is your 1040, means if you're preparing your return, your wages, if you have 10 businesses, that income, and coming to adjusted gross income, that's what we're talking about here. So as long as if you're within less than these thresholds for single filers and married filing joint, there's no issue about SSTB versus non-SSTB. Simple thing is you get a deduction. So if you're below that, hypothetically, your QBI, which is qualified business income from that business, is say $100,000. So your deduction becomes 20%, which is $20,000. No limitations as long as you're below that threshold. Now the limitation kicks in once you're between that threshold, means the $170,000 is a lower taxable limit, and then 222 for single filer is a higher taxable limit. So if you're in this range, in these 2 ranges for married filing joint versus single filer, for non-SSTB taxpayers, which is if you're not in services, when I say non-SSTB means I own a restaurant, manufacturing facility, those kind of non-service businesses actually. So if I'm a non-SSTB taxpayer, I'm within that range, I have no issue. I can take that deduction in full. But now if I'm SSTB, there is a phase out. So if you're within that range, there will be a phase out, your deduction eligible income going down. Once you cross that $220,000 for filer, single filer, and married filing joint 440. Now for SSTB owners, which is again the services, businesses, those kind, no deduction for you once you cross that upper limit. But then in third scenario, now you crossed upper limits, essentially in both areas. As I said, like for SSTB, it's gone for you, no benefit. But now if you're non-SSTB, example, restaurant or manufacturers, there's more factors come into play. And that's what the factors I discussed before, mentioned before, where W-2 wages and property factors come into play. And I'll show you an example as well, like for this last scenario, so you kind of like visualize what I'm talking about. So this is an example. Mark owns a restaurant and has a taxable income of $500,000. His QBI, which is a qualified business income from that business that he runs, is $200,000. He paid $20,000 in wages. $50,000 are the property in the business. So now how the example goes, you'll see the first line is, in general, the rule is it's 20% of your qualified business income, which is like a net profit essentially from your business, right? So ideally, if you had no restrictions for non-SSTB owners, you would have got that $40,000 as a deduction. However, since you crossed that upper limit, now these other factors come into play. So the deduction is greater of either 50% of qualified wages, which in my scenario, as I mentioned, like the wages paid was 20. So now my deduction is $10,000. And then the other factor is 25% of qualified wages plus 2.5% of your adjusted basis in the property. So if I do the math, 25% off of that $20,000 is $5,000, and 2.5% of that $50,000 is $1,250. So now the issue is, since it's a greater test, once you cross the upper limit, so your deduction becomes $10,000. Hypothetically, if you're within that range and if you're non-STB, your deduction would have been $40,000. So there's a lot of cool planning trips. Like if you're my client and I'm doing some planning techniques, one thing is I could issue a little bit more bonus, so my qualified deduction. But the thing is, there's a lot of moving things if you play with the numbers that you have to assess that, increasing this parameters doesn't decrease the other parameters. So it's a lot of like what if scenario. But normally when I'm doing tax planning with my clients, I am trying to figure out like how can we maximize this. But this gave you a bigger picture, like how the deduction works. So now consider aggregation. What that means is if I own, say, the best scenario is if I own two businesses and I'm making that cross that upper limit income taxable, I have a limitation. But what if I aggregate those two businesses? Now my wages are combined, my property is combined. Now my deduction could be higher. But of course, you have to do a decent amount of analysis to figure that out. Like you have to see first thing is, can you aggregate? Because there's a separate set of rules for that. Then once you say, yep, I can aggregate, but now you will see, okay, if I combine those 5 businesses, can I get a better deduction? Instead, if I do standalone basis, 5 businesses, I may be limited. But if I combine them, my deduction might be greater. So that's one good planning strategy. This is like a mandatory thing that we do, when we have multiple businesses clients. So now I will kind of take you back to Tax Cuts and Jobs Act days, because CARES Act, which was passed in 2020, changed a lot of those rules that TC, Tax Cuts and Jobs Act, placed. So now we're in 2021, and all those CARES Act rules are gone. So now we're back to the old rules. So one big thing is net operating loss limitations, what that means is if in 2021, I have a taxable loss of say $100,000, which is being carried forward to 2022. The thing is, next year, if I have say $200,000 income, right, I can only use 80% of that taxable loss from last year. So what that means is, like, now that since that 20% income is not sheltered with this NOLs, now we might be in a position of tax due in that form. And this changed in 2021. So last 3 years, this rule was suspended because of CARES Act. So a lot of times people used, people didn't think twice, but now these rules are back.
And it's your 18, 19, 20, 21 losses, even though you were able to, deduct them, any carryovers from those years are now limited to 80% of your taxable income.
Yeah.
And and that's for corporations and individuals.
Yeah. So that's one big thing that, you might think you have losses, but no, this limitation is back. There's an example I gave, like where a calendar year tax rate generates 200,000 in NOL, followed by 100,000 in taxable income next year. Now, since only 80% it's sheltered, 80% loss only shelters that income. So now you have a $20,000 of taxable income. So that's one thing I was talking about. And then the remaining loss is carry forward next, till you use it, till there's no limitation when you can use it. You can just keep carrying forward right now. CARES Act suspended this limitation temporarily between 18 through 20, but those rules are back. CARES Act also created another big opportunity, which I saw, in my experience, like quite a few people missed, that if you have losses in these years, you could carry back those losses 5 years and take a refund. So the good thing is you created, for a C Corp essentially, right? You created losses at 21% rate, right? Because that's what tax you pay. So it's a 21% bracket if you carry forward those losses for future offsetting of income. But historical rates 5 years back was 35%. So technically, if you 21% rate loss, you carry back and get a refund at 35% rate. So there's a rate arbitrage. You get a bigger refund carrying back versus going forward. So that's one thing. And this rule is mandatory unless you elect it back. So if I get a new client, the first thing I look at is this, like if someone had losses, did they carry forward? Did they carry back? If they carry forward, for whatever reason, they shouldn't, they could. Is there an election in place? Because if the election is not in place, then you are forced to carry back and amend all these returns. So it's a risk out there. I always check that first. So, the tip was review if you had losses in 18 to 20, try carrying back if you had a better rate. If like essentially what I do is if I could carry back the same loss or carry forward, I test how much refund I'm going to get. So if I'm getting a better deal carrying forward, that's the way. Then this excess business loss limitation is also back, which works similar as net operating losses, but it's a little bit different in this area. An excess business loss is the amount of your aggregate trade or business exceed your gross trade or business income plus a threshold amount subject to inflation. For 2022, the threshold amount was $270,000 for single filer, $540,000 for married filing joint. And I kind of like, this is a definition, but I want to explain a little bit more through an example. So let's go. For example, suppose you have $500,000 of gross income and $800,000 of deduction from your business, right? So now your excess loss becomes $30,000. Why? Because if you subtract $800,000 of deduction to $500,000, and then you have that threshold of $270,000, right? What that means is you're allowed, out of that net $300,000 loss you have, $800,000 minus $500,000, you cannot use $30,000 because it's over the threshold. So that becomes your future, that becomes essentially a net operating loss for a future usage. So that limitation is also back, but essentially you would only worry about this when if you have a high loss performing businesses, and now as a result, you're on your 1040, you have a loss in excess of, that 500,000 if you're married filing joint.
And the excess business loss limitation and the limitation on the 80% of deducting your NOLs or net operating losses, it's a way for the government to recoup some of the taxes by having you pay tax immediately instead of deferring all of it, to cover the other provisions for which, like stimulus payments, and which obviously gave a lot of money back to the taxpayers.
All right, let's go forward. Another thing came in back in the business is 163J limitations, and it's a big deal in 2022 tax year. So what's 163J limitations? What that means is, like, hypothetically, if I have a business, a rental business, I have a real estate company, which is it has a big mortgage. Because of mortgage, now I have a lot of interest. So this limitations limits your deductibility based on a formula, how much you can deduct in that 1 year. So that's one limitation. And, this is essentially a definition of like how that limitation works. The taxpayer business income, 30% of adjusted, but I have a better solutions. I will walk you through the example. This is a pretty good example why it's a big deal for 2022. In 2021, you will see unadjusted taxable loss, which is essentially, your expense, your business income minus deductions is negative loss of 300,000, right? But out of that 300,000, there is a business interest deduction embedded in that 300,000 of 300,000, right? Now your depreciation you took to come to that 300,000 loss is 200,000, which is generally up till 2021, you could add it back. So essentially where it starts off with the loss, then you add back certain items, which is interest you can add back depreciation. It becomes an adjusted taxable income of 800,000. So it's a 30% of 800,000 that's allowed. Then, of course, you have business income of 10,000. So essentially, out of that $300,000 of business income, interest, I could only deduct in this year 250,000. The other 50,000 is not allowed. But that changes in 2022 because that add back of depreciation or amortization is gone. So now what will happen, since you don't have that add back, you see at the bottom, now your deduction is from 250 drop down to 190 and your disallowed is, so that's a big blow for a lot of, one thing, what you could do to avoid it, like, maybe have a better, one thing I could think of is like it's constantly being explored, maybe refinance or do private lending where you don't have that much interest because there would be limitations. Before, a lot of people didn't think about it because they put assets into play and it's a big depreciation add back. So they were okay with small disallowance, but now it will change. One thing I wanted to mention is there is an election for this specific election is for real estate type taxpayers. So the real estate means if I run rental, if I do a mortgage, rental mortgage, all those real estate category, there's an election, which once you make this election, you're not subject to this, limitation anymore. But of course, that election comes with it comes at a cost because it requires you to depreciate assets in your business in a different life. So, but in generally, if you have a rental and you're subject to 163J, without doing evaluation, I think this election from 2022, if you have a lot of interest, if you have a lot of depreciation, you can add back. I think it's worth looking into this election because that will save you a ton of money. Yeah,
it'll allow you to not be if you're heavily, like HP said, have a lot of financing. That financing, I mean, it's going to change things quite a bit. So same with the R&D. We need to look at R&D more closely for next year. So a lot of things that are, need to be addressed during tax planning that could increase your tax income if you don't look at them.
Yeah, in 2020, I agree. And that election is not available for everyone, and there are some exceptions to it. So when you're talking to the advisor, I think, and you have real estate, and they haven't used this election before, this is one thing that you want to bring it up. It's a separate, after evaluation, you're not qualified for it, a different story. But what if you do qualify? It's a definitely looked at thing.
Mm-hmm. So hopefully we've provided a few items for, the owners and the businesses to look at for tax planning purposes, because it's pretty timely. Right after the October 15 tax deadline is a good time to address and assess for next year. And some of these tips and tricks will hopefully reduce your taxable income. So thank you for having us.
And one thing I just wanted to mention is, if someone hasn't taken advantage for employee retention credit, that their advisor said you're not qualified, or no one brought it up to them, which is the theme I'm seeing a lot. I think if you have employees and if you have not assessed this yet, I think you should definitely, you qualify or not, it is a separate story, but it's a must thing, like internally at Raymond, we kind of said, if a business have employees, we have to look at that for sure. And now we're like calling different clients and kind of like before, they thought they didn't qualify, but we're reassessing because it's a lot of money on the table.
Thank you so much, Himanshu and Shayla. Thank you for joining us for the Big Tax Strategies for Small Businesses part of the Small Business Webinar Series. For more small business webinar videos, check out our playlists that will be listed in the description below for information about APACC, the Small Business Action Committee, National ACE, and our speakers. All that will also be located in the description below. Please leave a comment on what you would like the Small Business Webinar Series to cover next, or what you would like to see as a small business. Thank you, everyone.
Thank you.